folks, as you're filing in, we're excited to kick off this webinar about secondaries, especially as it pertains to emerging managers. We have a Q&A panel where you all will be able to drop some questions as we get through the conversation. If it's relevant to what the speakers are talking about at the time, they'll probably incorporate that into their conversation. Otherwise, we'll get to it at the end. And I'll just kick it off with a round of intros. Phil, we'll start with you.
Great. Thanks, Noor. Hey, everybody. My name is Phil Haslett. I'm one of the co-founders of EquityZen, serve as our chief strategy officer. Started in 2013, basically an online platform for secondary trading of pre-IPO companies. Worked about 500 companies to date, and excited to chat more.
Dave, we'll pass it on to you.
Awesome. Big fan of EquityZen. Actually, we were investors way back in the day when I was running 500 startups. Hi, my name is Dave McClure. I'm a nerd here in Silicon Valley for the last 30 years or so. Have been a software engineer, entrepreneur, angel investor, and VC. That's in decreasing levels of competence. I guess I should say now I'm a secondary VC. And we buy small stakes in companies and funds, small being kind of $1 to $3 million. And yeah, a lot happening in secondaries lately.
Ira, last but certainly not least.
Thank you. Ira Simkhovitch here, Managing Director at Industry Ventures. I've been doing secondaries for over 15 years now. So secondaries nerd for a long time and have made it my life's work. We're an $8.5 billion venture platform investing in venture companies and venture funds, all the way from early stage all the way through later stage and also private equity. Thank you.
Drew, we just kicked off intros, so I give the floor to you.
Awesome. Did Dave and Phil also introduce themselves?
Yes.
Wonderful. All right. Sorry, everyone. Looks like I had a technical issue here, but back on. And so, as I mentioned, we're talking about secondaries and basically why early stage, seed and pre-seed venture managers are increasingly looking at secondaries as not optional, but perhaps even essential. And so this session's really designed for early stage managers who want to future-proof their strategy and better understand how secondaries might fit into their playbook. You guys have met the esteemed panel. Just so you know, my name is in product functions. Fun fact, I was a co-founder of EquityZen with Phil, so it's great to see him again. And then over there, Dave was one of our earliest checks and investors into the company. And then we've also all known Ira for several years, so we have like a good group of folks who've been around the block for quite a while, and I think we're gonna get a lot of gems from the crew over here. We're gonna jump into some quick poll questions before we get started. Just to better understand who our audience is, and so help us tailor, the discussion as well as help you guys understand who else is on the call.
Yeah, perfect. So the first poll question is on the screen. We'll give it just maybe 10 more seconds for you guys to fill this out, and then we'll show the results. Let's give it 5, 4, 3, 2, and 1. Yeah, I think no surprise here. But we do have a good amount of syndicate leads and others. Cool.
A lot of mysterious people.
Only 26% bots.
Yeah, if anybody has a note taker in right now, I haven't had a chance to attack those yet, but they will be out soon. I'll go ahead and launch our second poll.
By the way, I should mention there's another connection with Industry Ventures. When I was looking to sell a piece of my carried interest in 500 a few years back, I also talked to Ira and folks at Industry Ventures about that. That was kind of one of my first experiences being going through fund secondary transactions.
Unfortunately, Dave, you didn't take our offer.
I think that was probably a good decision on my part, but I'm not sure.
So give us 5 more seconds and then reveal results. 2, 1.
Right.
Look at that.
Okay.
50-50.
We got
Love
some
it.
newbies here, so this is good.
But he is secondary curious.
I'll have to ask the question again at the end of the call.
I'm surprised those numbers aren't higher. I would have thought that more people had done a secondary. What is your
And
primary interest in
last but
secondaries?
not least,
Maybe just a comment question for this my panel while we're waiting for this stuff to come in. Do you guys feel like the conversation vocabulary in private equity and venture capital is like vastly different in terms of secondaries? I felt like there's a whole nother language that private equity folks use for secondary than venture. Or you probably have the most familiarity with that.
Yeah, no, I think there is. And I don't speak that language. So that's
Yeah,
how I know is when
it's
I
like
go
a
into the room,
completely
I don't.
different language.
And people think I'm speaking a different language when I talk to other participants in the ecosystem, VCs, founders. So we're all aliens in one form or another.
gonna jump in quickly to
Okay.
just let folks know the results are on the screen.
Not too many people worried about employers or founders.
Yeah. And with that, Shrey, I'll give you the floor.
Awesome. Thanks for those polls, and everyone, thanks for participating and letting us know who's kind of on the call and what their background and experience with secondaries are. So let's get into it. Maybe we'll kick off with one that everyone can chime in with their thoughts on. Basically, what are the dynamics in tech and venture that are making early stage and primary investors turn to secondary markets? Like, let's kind of set the context here a little bit. Ira, maybe you want to kick us off with this one?
Yeah, no, happy to. I mean, I think for folks who haven't seen the stats, 70% of all distributions to venture funds last year were through secondary sales. And hopefully that's a lower number this year. But what we've seen is just elongated hold periods, elongated time to liquidity. Now it takes over 8 years from seed investment through an exit for the average life of a VC investment. So we're, naturally turning to secondary markets as companies and funds stay private longer.
Thank you. Dave, anything else that you would add in terms of what you're seeing in terms of market dynamics today that have kind of
Very
precipitated?
limited IPOs up until about the last 2 weeks or so. So anybody and everybody looking for liquidity has not been seeing it from the primary market, at least, primary public market, I mean. Not very much in the last 3 years. So a lot of pent-up demand for liquidity from everybody.
And we could say the same even for maybe the M&A market as well, right? Based on the regulatory posture of the FTC and how they've approached big tech, who is probably a big source of acquisition. With the regime change in Washington and a new FTC leader coming in, do you guys see the M&A markets potentially opening up a little bit and creating a bit of a pressure valve here, or should we kind of expect more of the same? We've seen the Scale AI deal that was artfully structured recently as well. Phil, maybe you have a view?
I'd say, yeah. So maybe before touching on the M&A part, I would also say like one of the dynamics on why, you need to have a buyer for these things as well, right? And so one of the things that's played out at least over the last 2-3 years is that if you were a traditional growth equity investor that invested in late stage private companies and you solely focused on doing primary capital raising investments, your pipeline was pretty tight over the last few years, right? And so if you wanted to continue betting on winners, a lot of them had raised a ton of money in 2021 and didn't need new primary capital. And so you started looking into the secondary markets. So that's kind of the other side of who's matching up a lot of times with an institutional land on these like seed stage funds that were looking for liquidity because of the aforementioned kind of lack of liquidity. M&A side, yeah, agreed. I think if you compare the environment from a regulatory perspective and administration perspective, 6 months ago, things look a lot more optimistic, starting to see some deals get done. It doesn't mean like everyone's out of the woods and that any company that raised a bunch of money in 2020 or 2021 can sell, but it's certainly, objectively in a better spot than it was, 6-9 months ago.
Yeah, I think the stats that I saw PitchBook publish some data maybe last quarter that was showing total liquidity probably 2-to-1 M&A versus secondary and public listings. I'm not sure what period of data they were covering there, but it was certainly showing that secondaries was a big part of the market. Public listings was a little bit lower than secondary, and acquisitions were higher. And I would agree. I'd say probably going to see more acquisitions now, but may not be flood. I think we are going to see more IPOs, though. I mean, again, hard to make any predictions in this environment, and somebody could, pull the trigger on any number of objects in the sky and on the ground, and that might change. But for the moment, everybody seems to be optimistic about IPOs for Q3 and 4, and hopefully for 26.
Especially if you have a stable coin.
Yeah, that's a really interesting article by the FT. I don't know if you guys saw that. That was just describing not just trends in stablecoins, but stablecoins really driving demand for USD as a reserve currency because of the construction of stablecoins using treasuries. I don't think most people really understand that. I thought that was just a fascinating description. And then the Walmart and Amazon announcements also about stablecoins. So stablecoins is the hot all of a sudden. Finally, a use case for crypto.
Interesting stuff. We may have a separate webinar altogether about the IPO window or even stablecoins. But
Yeah.
Ira, coming from a firm that is one of the pioneers in secondaries, tell us a bit more about the different access points to secondaries and how industry thinks about them and how fund managers should think about them. Just throwing a few out there, right? You could go through the board and already be on the cap table and help situationally with executives and other folks who need liquidity. There are tender offer programs that are out there that have gotten very formalized and programmatic over the last decade or so. And then you could engage directly with employees and early shareholders. And there you could work with brokers. And then there are also platforms like EquityZen where a lot of deal flow happens. So maybe you could describe a little bit about each of these, and then through the lens of maybe an emerging manager, how to kind of think of them and their usefulness for emerging managers.
Yeah, one of my favorite comments that I've heard was that many founders and employees don't appreciate that there's a whole business behind the check that they got written into their company, right? And that's the underlying that is the entire capital stack that powers the entire asset class, which is the fund that if you think about the shares in the company that are owned by the fund, commingled with other fund investments, unless it's a single asset SPV, and then the GPs and LPs behind that, and the multiple funds that the GPs are managing as part of a business, right? And I think what's changed over the last, certainly over the last 20 years and even more over the last 10 years, is that we've seen a explosion of liquidity options at every different part of that entire capital stack. So at the very atomic level of the company, certainly founders and employees and early shareholders, and that could be through tenders or through one-off secondary trades, up to the level of the fund, where you could see a GP-led secondary, you could see a strip sale, you could see a continuation fund, and then moving further up the stack to the LP level, we're seeing massive LP trades, large pensions. There was a $5 billion LP secondary trade earlier this year. These are pretty big deals, or can get big, and then the GP level liquidity as well, which is, and so what I'd say is that there's a solution for any one of these liquidity needs, but what we're seeing is that the smartest firms in the world are addressing every part of that entire value chain, from the atomic unit all the way up to the LP level.
About half the audience is new to the secondaries world and hasn't done a deal before. There are a couple terms of art you threw out there, Ira. Maybe if you want to unpack what they mean for us. the use of continuity funds or strip sale. If you could just explain those terms.
Let me just patch in my fireflies to explain this. But no, I think there's definitely some new terminology here. It's coming up in the last 5 to 10 years. A GP-led secondary simply is a solution for liquidity at the fund level that is really being managed by the GP. And why are we even talking about that? We're talking about that because the DPI for funds that are 8 years old right now, the median DPI is about 0.2x. So what we're seeing is that funds regularly need to extend past the 10-year life and past the 2 1-year extensions, and many reach 15 to 18 years of age or older. And there's a whole slew of new tools available for managing that liquidity. And it could be single asset sales out of the fund. It could be a strip of assets sold out of the fund. That's a popular solution. Could just be a couple assets. One fund could sell with another fund's assets at the same time to give them more kind of diversified and could be a richer deal for the secondary buyer, or it could be a whole new vehicle setup where the assets are transferred into that vehicle to continue management and upside for the GP and to maintain board seats and there's other incentives as well. But all of these things are now on the table for funds that are reaching a certain stage of their life.
If they have the right assets.
That's where Dave comes in.
Well, I was just going to comment. I think a lot of people might get very optimistic about all the talk about secondaries and driving liquidity. And I would still say except for the fortunate few and maybe, funds that have those top 10, 20 names in them, it's still more of a buyer's market, especially so at the fund level rather than at the single asset level.
Yeah, that's right. I mean, if you add up the entire dry powder for venture secondaries, probably above 50 billion, probably below 100 billion. But you look at the total value of private venture-backed companies, and you're approaching almost 4 trillion of value. And so there's certainly not enough secondaries dry powder to get liquid. But again, kind of going back to my point on where are the needs for liquidity and using it as a tool, right? It's not going to, most likely secondaries aren't going to get you to the full, a full fund solution and exit, unless your fund is very small. But more likely than not, it may be that solution to get you from 90% DPI to 100% DPI in year 10. Or it may be a solution for, like Dave was kind of mentioning, it may be a solution for your best company that's about to go raise a new big up round that's way oversubscribed, led by Andreessen Horowitz, and you can sell your stock into that, right?
Yeah, I think maybe just for reference, I probably shouldn't be disclosing too much of the data, but if I look back at 500 Fund 1 and 2, which are now respectively 15 years and 13 years old, I think Fund 1 sitting at 3x DPI. I believe at least a third, if not half of that, came from partial secondary sales. And in the Fund 2, which I think is somewhere around 2.5 to 3x DPI, most of that came from partial secondary sales related to Canva. So at least from my experience with those two funds, a very significant portion of DPI came from secondary sales. Unfortunately, for a lot of people, I think probably all this advice about selling secondary people should have been doing in 20 and 21. Hindsight's 2020, I guess.
Yeah. I think the advice we give to sellers that are saying they're going to kind of wait it out is, prices may go higher, prices may go lower. Right now, there is somebody willing to buy something from you, and that's not always the case. And some people got burned by holding off in 2021, and Some people have done well since then. It's, it's just
Yeah.
it's a reminder, kind of back to Ira's point, right? You think about like how much dedicated powder there is for these types of transactions. As the numerator, the denominator is really large, right? But at the same time, also like these shares don't exchange hands at the same rate like that public companies do, right? Like I think there's been some
Certainly
estimates. I
not.
think from you are actually industry, it's maybe like 1 to 2% of the overall market value probably exchanges hands in a given year, right? So you take that and then you distill it down to it's a bunch of companies that don't do it at all, either because no one cares or because the company won't allow it, right? And so it's just something to keep in mind, right? You should enter it with cautious optimism on your ability to get liquidity.
Yeah, I think a lot of it, probably at the current moment, your opportunity to get reasonably close to fair market value is when there is a primary round happening, or at least that a primary round's happened recently. Again, with the exception of, high visibility names where you can get liquidity and probably even at a premium. Most names, it's hard to get a read on where the company is unless you have access to financials. And as a result of that, most secondary activity that happens outside, let's say, a 3 to 6 month window of the primary round, people aren't sure, where the, where the company is, whether they're doing well, and there's usually, a heavier discount if you're applying for trying to do a secondary outside when a primary round is happening, unless there's data about the company.
Want to just double back on one point there that I think came out of Dave, your anecdote on 500 and Canva and like the utility of secondaries. Just wondering if anyone has any views on, from the manager's perspective, does the secondary liquidity, does that help towards, having more investable capital either through recycling or kind of showing some distributions when you're in market for the next fund? Has that like proven to be like a useful tool for those purposes?
Well, I mean, I guess looking back when I was running 500, we definitely, had some times when we needed some cash, and sometimes we would do a secondary, either for our own operational needs or potentially to distribute to folks. But it's probably, smaller transactions for operational needs. If we're talking about returning money to, LPs, then we're really thinking about a more substantial transaction. And yes, that was, a big part of it. Fortunately, I would say myself and, my former co-founders who were now running 500, they did take advantage of that and sell some secondary when it was a high water mark. Maybe not as much as everybody would have liked, but at least we did some during that period of time. So yeah, I think it's really important. Again, there's tons of conversation right now about people thinking about how do you think about when and why to sell, and there's a whole bunch of factors to consider there. But probably trying to figure out what parts of your portfolio are growing faster or slower than say 30% year over year, whether you can get close to fair market value for those assets or at least not too much of a big discount. Whether the DPI you're generating is material for your fund, let's say, at least 0.5 to 1x or more. And then what the stage and age of your fund is, if you're, very different conversation if you're only around year 7 than versus if you're at year 12.
I would put
But
yourself
it really
also.
matters a lot. Sorry, go ahead, Ara.
Oh, sorry, I jumped in. I would say put yourself in your LP shoes, right? There was a time, this is a long time ago now, but there was a time when private equity and venture funds didn't raise a new fund until they had returned the capital in the prior fund, which is almost comical now to think about. Now, with the elongation of DPI and with the shorter fundraising cycles and intervals that funds are pursuing, right? Fundraising every 2 to 3 years and taking 8 years to 10 years to return capital. What that means is LPs who have generally, at least an institutional LP, has a fixed allocation to private equity and venture. So if it's 15% of the portfolio, they ideally want $1 in, $1 out, right? And growing NAV through that through their hold period. What that means, though, is that these venture funds we often come across have raised 3, 4, 5 funds and are barely returning capital in their first fund, and then going back to raise more money from their LPs. And that's why part of the reason why fundraising is so hard right now is that they're going back to ask, and the LPs are pushing back and they're saying, well, I've already written you 3 or 4 or 5 checks, and I haven't even gotten 1 check back. I could see that your TVPI is good, but where's my DPI? And so I think the key for secondary, right, we can all probably agree it's painful to sell some of your upside in your favorite investments. It's difficult to give up some upside, but there is a trade-off for DPI. And I think marching towards your target DPI, which is returning capital at a certain pace back to your LPs, I think is worth the trade-off. I think there's a lot of LPs who would rather see a 3x fund with a 1x DPI than a 4x fund with no DPI, right? So as
Absolutely.
a sustainable part of their portfolio where they can continue to recycle into new commitments.
Yeah, I was just going to say, I think it's the part of the challenge or what this discussion should be about for emerging managers is how you're talking about your plan for liquidity for your fund before you've raised from your LPs, right? Because the old mantra of like a seed fund will have, 30 investments and 2 really matter. When that statement was made, the 2 that mattered because you held them all the way through a full exit, right? And so if the expectation from your LPs is that is how you're going to hit your target numbers, and then you kind of jump on them with a surprise that you're taking liquidity out at Series B, that's obviously going to also hurt your relationships with your LPs.
Unless your LPs are people who are buying that position, perhaps.
True too.
I was wondering, I don't know if you can maybe talk about a subject that probably is of interest to folks, because you're also in the business of funding funds. Could you explain what a staple is and maybe how that sort of works in the market if somebody's looking to maybe raise a new fund but has some great assets that might be for sale? How would that work?
Yeah. Well, raise your hand if you want to stay, but no. No, it's a part of the ecosystem that has evolved as many groups like ours do both secondaries and primary investments in funds. So we'll buy LP interests, and then we'll also commit to new funds. And I think it's become a interesting and important part of the ecosystem to for fund managers to view secondary funds like a real partnership, because there's so much trust that goes into a GP-led secondary, as we were talking about earlier, right? In many GP-led secondaries, the secondary funds like ours are actually becoming LPs in these newly created vehicles that are all secondary assets. And as some of the best VCs in the world, some of the largest firms, you've seen it in the news, right? NEA, Insight, General Atlantic are all creating these large vehicles, and it's mostly funded by their LPs. And if the LPs make money on these transactions, they'll do another one, right? And it's a win-win for all the parties involved, because there's DPI generated, there's continued management for the GP, and then there's also a transaction for the secondary buyers. When that trust is broken, if there's a GP-led secondary that doesn't work, that may turn off that part of the market for that particular fund. And so, I'd say the give and take on some of these transactions is that oftentimes we as secondary buyers will contemplate how we can be a good partner for these funds that we work with.
Just a quick PSA, everyone. I see that there's one question from Shafali in the Q&A. We're going to reserve some time at the end for that, so please get your questions in, and we'll manage that queue. And then probably in the last 10 minutes, we'll do some questions. Let's maybe change course a little bit. We've seen from our data at Sidecar that the majority of secondary transactions involve common stock from employees and early employees. Phil, your vantage point at EquityZen, where you have a platform that works with a lot of employee shareholders, what should managers know about working with employee sellers of these shares?
Yeah, so maybe the first thing I'd tackle too is maybe why that's the case, why there are, a higher frequency of secondary trades involving kind of common stock and early employees. And I think it's just a function of what a cap table's ownership looks like, right? There is a concentration from a percentage ownership basis across founders and lead investors. And then there's a long tail, a very fractured long tail of typically employees and ex-employees that were issued shares in connection with their employment. I'd say the one thing to keep an eye out for that's probably most important is that the kind of financial literacy of a employee or ex-employee selling is going to be not the same as you as, a manager of a fund, right? So understanding the dynamics of bids and asks and fees involved and the timing of a trade, that's probably the biggest difference. And as part of that, a lot of times a trade that may feel small in size or trivial even to you may be incredibly life-changing for that proposed seller, right? Somebody buying or somebody selling $200,000 worth of stock that has to exercise their options that cost 30 grand. For a lot of people, that can be probably the biggest financial decision they've ever made if they're a 27-year-old engineer or something like that. I think that's something to keep an eye out for. The third thing I'd say is common stock tends to have more restrictions alongside it compared to preferred stock. So you'll see more often than not some type of board approval that's required as part of the transaction. Almost always a right of first refusal involved. And what that means is that when you submit that secondary transaction to the company or some of its major investors typically have a right to match the bid that you present to buy those shares and can buy them themselves. And that happens not infrequently. And so just kind of going in eyes wide open that you're working with someone that's less familiar or this matters a ton to them, and it probably comes with more analysis of the structure, I think are probably the most important things to look out for.
Awesome. Thank you. And you just mentioned board approval, which gets me thinking that, private companies are private for a reason, for many reasons. One of those reasons is they want to control their cap table, right? They don't want to be a public company where anyone can kind of hold the shares. Maybe Ira, you could share a little bit on this one around, oftentimes the company or the founder or the board is involved in navigating these transactions when it's buying, shares or selling shares of a portfolio company. What advice would you give to emerging managers navigating these board and founder discussions when it comes to buying and selling shares from employees or other cap table entrants like early investors, angels, et cetera?
Yeah, I'd actually say one of the advantages of being a small venture fund is that it's less disruptive to sell secondary in a round or potentially between rounds. If you're not on the, if the company has reached a Series B plus scale and you're not on the board, folks are not looking to you for signal as much. You've already made a solid return. I think it's actually, you're a little bit more nimble on the exit than if, for example, if you were the Series A or B lead, asking for liquidity is a different conversation. What I'd say is flag it early and often with your founders, right? So that founders, when they're raising new rounds, can use it as a tool. These round sizes are getting larger. Of course, there's the large platforms that are coming in with pretty large checks on some of these companies, and they're doing both primary and secondaries. And a founder, if they only want to raise $100 million, but are getting term sheets where folks want to put in much more than that, the founder can then use your secondary. If you're a small shareholder, they can use that to sell. You could sell your stock to the lead or even the syndicate that they want to bring in as well. So it increases that round size in a nice way for the best companies. That creates some good synergy between founders and employees and the shareholders. Where you don't want to get caught up is blindsiding the founder with a secondary trade at a valuation they don't like, and especially going into a fundraising, that's where we see folks get tripped up is, and that could be potentially really harmful for the relationship. And so that's what you want to be, that's what we want to be careful about.
Great points. So communicate early and often, be sensitive and aware of where your founder is in their own capital markets and fundraising life cycle. And oftentimes there might be a lot of win-win associated with how the founder wants to manage their cap table heading into primaries. So maybe there's like an opening to have like a good dialogue. Thanks for that. Dave, your business, in addition to buying shares of private companies, you also have a substantial part of your strategy in buying GP and LP stakes. Can you tell us a little bit more about that business, why you think it's interesting for you,
Sure.
and why you think it's interesting for early stage managers who you work with on these transactions? Kind of like, what do you think is cool about it? And then what's the value prop to the managers you work with?
Sure, I'll try not to go too far down the rabbit hole, but one of the reasons that we got interested in it was because 5 years ago I was on the sell side. I had left 500, had a fairly substantial amount of carry in my first two funds. Fund one had a big position in Talkdesk, Intercom, Lucid, a few other assets. Fund two had a pretty big position in Canva. And so I, was looking to find someone to buy that potential. That was actually why I talked to Ira and folks at Industry and a few other people. And I guess it was a little bit of a sticker shock moment because although I thought those assets were great and were heading towards IPO and growing, there weren't very many buyers. I probably reached out to a bunch of people, but realistically, there was maybe 3 or 4 buyers of fund interests. In this situation, carried interest, not even just an LP position, which is a little bit rare. And so that, although I ended up getting a transaction done and taking some money off the table, it was kind of an eye-opener in understanding, hey, there's not too many people in this business, particularly, let's say, for sub $5 million transactions. Originally, I was, planning to sell a position for about 3, and nobody really wanted to talk to me for less than 5, I think, including Ira at the time. I ended up selling about 10 and buying a house in Silicon Valley and starting the firm, but it really made me realize that, maybe if we set the stage for where each of us is active, I would say EquityZen, I think, is probably more active in sub $1 million transactions. Ira with an $8 billion fund is probably looking more, transactions north of $10 to $20 million, at least most of the time. And we're maybe in between, probably looking at $1 to $5 million transactions. There's lots of different people buying and selling individual positions at each of those scale. But at least for fund interest, there's not very many people buying positions smaller than $5 to $10 million. At least that market is still developing. Again, open to contradiction if I or other folks think that's different. But it seems like there's not a lot of people out there buying fund interests below a certain size. And so that's kind of why we got into it, was because not too many other people were doing it. And we at least knew something about our own portfolios from 500 and how we might, want to look for liquidity. So it's kind of easier for me to imagine who's on the other side of the table, having gone through that experience myself and managing a few funds that were already, at 10, 12 years.
I'd be curious to hear from you, Ira, about like kind of the evolution of LP interests, like venture capital LP interests, like the market, because kind of my read, because we, EquityZen almost exclusively does kind of direct secondary. So that's like actually buying or selling shares of a single company versus multi-company like asset sales. I wonder, I think it'd be helpful maybe for the group to hear like how that's evolved, because it candidly, like kind of when we started in 2013, 2014, my understanding is like the VC LP like market was like this big. And if in here were like, trades that were probably like the biggest funds, like
Right.
the DFJ Fund 3, right, that was still around and happened to have SpaceX or whatever. And so I'm just kind of curious like how it's evolved and kind of probably is harmonious with like Dave's prescient timing of kind of getting in the space.
Yeah. It's part of the market that you may not see, even as a, you're a founder, you have no idea that your shares are in a LP interest that's being traded from, a pension to a large secondary fund, and you have no idea, and you probably don't care. But the reality is that that part of the market is by our measure, it's about half the market of venture secondaries, and it is growing at a pace of 20 to 30% year on year. So our estimate is that it eclipses 200 billion this year. We used to be surprised to see a
When you say 200 billion, Ira, you're including PE, not just VC there. Is that correct?
Including PE.
Yeah. Okay.
We used to be surprised to see a portfolio of venture or growth that was above 500 million, and certainly be surprised above billion. And we've already seen almost a dozen this year. And most of them have traded. So what we're seeing is that LPs have taken that problem I mentioned earlier in the call into their own hands. The GP has asked for 3 to 4 to 5 checks into their funds, but hasn't returned capital in the first fund. And so how can they continue to write, if you're writing $10 million checks into every fund, how can you keep writing those $10 million checks unless you mass sell all the old stuff? And so that's what LPs are taking the problem into their own hands and rotating their portfolio on their own so that they can continue to re-up in the same size. And there's a market to absorb it on the other side, which I think is continuing to grow with the seller volume. What I'd say about that market is that it's a little bit different. It tends to be much more larger funds as the buyers. The transactions tend to be more diversified, right? Because if it's a multi-LP interest portfolio, there's some pollution of the top holdings versus like a single buyer of a single asset. And I would say that there are some restrictions, certainly for certain funds, which could make things difficult. But I'd say for the most part, there is an openness and an understanding amongst the GP community that LPs really do need to take this problem into their own hands and sell their portfolios to generate liquidity.
Awesome.
Yeah.
Thank you.
Maybe just to unfold that a little bit, I think one thing for emerging managers or anybody who's interested in selling either on behalf of themselves or for their LPs, selling fund interest is a different valuation exercise than a single asset. Obviously it's the same exercise for all the different companies in there, but if you think about it, we tend to describe it as sort of like 3 different buckets. We look at companies that have a high probability of exit. Typically, these are unicorn companies already on their way to an IPO, maybe 100 million plus in in revenue, excuse me. Noting that today that may not be anywhere close enough to go public. You might really be realistically thinking about 300 to 500 million in revenue for companies to go public. But at least they're in the reaching distance. There's a second group, which we probably call affectionately centaurs, which might have $100 million exit potential, but these are probably more M&A than IPOs. Maybe there's a few companies in there that, if they're growing fast enough, could eventually get to IPOs, but perhaps on a longer horizon. And then there's kind of everything else. And I think the big difference for emerging managers is they tend to value everything in their portfolios equally. And my guess is Ira and myself would look at that and really only look at that first bucket of IPOs as the value drivers for that portfolio. We'll probably discount those to some extent. The middle bucket of M&A exits is kind of gravy. We don't necessarily have a lot of expectations about that, but we would probably significantly discount that group because they're not definite IPOs. And the third group, we probably write down to 0. And those are companies that are maybe, have raised a Series A or B, maybe have 10, 20 million in revenue, might even be profitable and growing, but there's just no probability or predictability around their exits because either they're too small or they're not growing fast enough. And so when you look at those portfolios, that first group might be half or more than half of the overall portfolio value, but the second and third groups could easily be 20, 30, 40, 50% of the portfolio value, and it's going to be pretty substantially discounted. So not trying to be an asshole, but just to prepare emerging managers for how the buyers think about this, you really have to focus on what are the value drivers in your portfolio that are large, growing fast, and likely to exit within, let's say, at least a 5-year window, if not a 3-year window. And that probably substantially reduces what they think of as the value of those portfolios. And that was the sticker shock exercise I went through 5 years ago when I was looking at selling my positions in some of those companies. But I think it's something that everybody who's really considering this should consider. Longer conversation we can have about maybe structure and asset coverage and other ways to sort of close the gap between what the seller wants and what the buyer wants, but at least understand how valuation works from a multi-asset portfolio. It's very heavily driven by the largest positions that are likely on an IPO path and not very much based on the long tail.
Super insightful to better understand how early stage managers can contextualize their whole portfolio. Along these lines, when you do have the benefit of companies that break out and can end up raising a lot of capital, let's talk about how managers should contextualize themselves in the capital stack, that is early stage managers. And
Pro tip, sell some of it on the way up.
there you go. Heard the pro tip.
Don't hold your winnow's 100% forever for too long, at least,
So a few months ago, I remember reading a blog post from Hunter Walk, and this one stuck out to me. He said something like, angels and seed investors are better off thinking of themselves as common with a 1x preference once tens and hundreds of millions of dollars have been raised by the company. Can you unpack that a little bit for our audience? Maybe Dave, if you want to start that one off, and then maybe for other folks, do you agree with this take? And then what should it mean for seed stage investors and angels as you start having a breakout company? Right? One thing you just mentioned was sell on the way up, but how does it change where you are in the capital stack?
Sure. Well, I think the key question here is to understand preference stack and what that means. And so if you think about, who has a claim on the assets of a company, or in this case, maybe a portfolio, the lenders or debtors, people who've lent the money debt, get paid first. Then equity holders get paid first. Typically, the last round dollars in get paid first. But it's important to understand, whether the different share classes are pari passu or whether they're not, and whether there's a liquidation preference. So if everything is pari passu, then all preferred shareholders get paid out equally. And then common shareholders would get paid out, I believe, after that. Again, if a company goes public, those common shareholders will be treated equally. But in a private transaction, that may not be the case. And sometimes different share classes have liquidation preference. Sometimes they don't have liquidation preference, but they do come first. So if you think about a company that might be valued at $1 billion and maybe has raised, let's say, $400 million worth of equity and $100 million worth of debt, if the company exits for north of $1 billion, everybody's happy. If it only exits for $500 million, then those debtors and equity holders will get paid, but common shareholders might not. If it exits for less than, say $400 million, then the debt holders will get paid. Some of the equity holders, all the equity holders will get pushed down a little bit, and it depends on liquidation preference and how they get paid out, who gets what. And in a really negative scenario, it might be the case that only the debt holders get paid out, or only the last round equity holders get paid out. So important to understand kind of how much capital the company has raised, what's the structure of that capital between debt holders and equity holders, what's the rights of the individual share classes of preferred shareholders, and then common, which sits last, where does that sit in the capital stack? And there may be cases where some of the common still gets paid out in a transaction. In many cases, even in a cram down, there might still be money paid out for common shareholders, but that's not necessarily a guarantee. sorry for that long-winded explanation there, but that,
Great.
the short story for that is it depends when and where you are in that capital stack, how much money that has been raised for that company, and where's the valuation of the company going to end up when it either gets acquired or goes public. And you got to figure out where you sit in that capital stack. And Hunter's point is early stage investors, even if they're preferred, might look a lot more like common than the last round of capital that's raised.
Common stock with benefits. That's what we call it.
Maybe Phil, you want to expound on that, and then we could go to questions, right? So I think Dave, you touched a lot on like making sure everyone understands the details of the structure that comes in,
which is not always available to retail folks. Sorry, I'm saying the word retail there, but that's on both the seller and the buyer side. Employees may not understand all that stuff, and a lot of buyers of secondary who aren't, institutional or professional may not understand that, and they may not have access to that data.
There's also an element, I think, of interest and incentive alignment for early stage investors. And as the capital stack starts getting more institutional with bigger checks and maybe different expectations on outcomes and what's already baked in the pie, I think there might be like some differences that happen. And maybe that's a part of the story here. So maybe Phil, if you want to chat a little bit about that, and like you kind of mentioned, common with benefits, maybe elaborate.
Yeah. So, if you're in the Series Seed or the Series A of a company and you've watched the valuation, gone up considerably, you're in a good position, right? But also as that capital stack gets bigger and bigger, the liquidation preference gets larger and larger, you look more like common stock. I think that's what Dave was mentioning. The benefits, though, aspect I would say is really that you probably have a bit more flexibility on liquidity for your shares, right? In almost all instances, a preferred shareholder has more freedom to sell their shares than a common stockholder. As an example, most preferred stockholders, assuming they're able to sell, typically don't go through a right of first refusal process. A lot of times that's not on the shares. It really is case by case with company, but that's primarily what we've seen. So that's where kind of like the benefits comes through. The second part is you also probably have more of a direct line to the company, right? If you have a position that's now worth $10 million versus the ex-employee that now has a position worth $10 million, you probably have more connectivity because, you gave that person a check when they really, really needed it. And so that can help too in constructing kind of a conversation on liquidity. And so you may be able to get a bit more going there. And then I guess the last thing I'd say too is you may find yourself as a seed investor where the company's now worth 5 billion or 10 billion, and in kind of the world with AI that can happen quickly. But in kind of older regime, company might be 10 years old and you may not even be interacting with the company that much, right? At this point, their newest money that came in was strategic. It was to help with, expansive partnerships or international expansion, right? And where you were incredibly critical to the company was helping them land their first 5 customers, referring over their first 5 employees. And if you're less involved there, I think it's an easier conversation to also kind of say, I'd like to return some money to my investors. I also believe there's probably people that can be more constructive or more additive to your cap table. Can we work on a solution? And I think that's been received pretty well based on kind of how we've seen seed investors interact on the liquidity side with companies.
Awesome. Thanks, guys. I want to take a few minutes to maybe do a lightning round on the Q&A to hit some of the audience questions. So let's get to it. What's the panel's view on GP-led continuation vehicles or continuity funds? Do they find it conflicting for the LP? Whoever feels like a quick hitter.
Yes, but every LP in the world is getting these notices for these transactions in their portfolio. So VC lags private equity in terms of GP-led continuation vehicles. VC lags the PE business probably by about 5 to 10 years. And so every one of our LPs is constantly reviewing now in their private equity portfolio and now increasingly in their venture portfolio these transactions. And of course there is a conflict because the GP is both a buyer and a seller of the assets, which is why there's a lot of importance around the process, the price, the notification, and the awareness of your LP base. that goes into one of these transactions that's super critical. And at this point has become an industry standard, but certainly needs to be communicated properly.
Awesome. Moving along, looks like there's two link questions here. What trends are you seeing in issuers' receptiveness to secondaries generally, and or linking, it looks like stapling secondaries to a primary? Phil, maybe you want to hit that one.
Yeah, general issuer attitudes towards secondaries. It's really company dependent. Sometimes it's VC dependent, like who led the recent rounds. Like we'll see some kind of patterns emerge. I would say
Name
versus
some
like
names, Phil?
absolutely not. But I think there's a general acceptance that secondary liquidity is a part of the ecosystem and it can't really be avoided. How a company determines they want to solve for that can be case by case, right? Tenders have become incredibly popular. One-off secondary transactions really depends on the company and also by industry. So I'd say overall, you've seen some instances of companies that are really restrictive. But I think overall there's an embrace for liquidity. It's just in what form it's going to come, and each company is a little bit different.
Awesome. Thank you. Looks like there's a request here for Dave. Can you repeat your pro advice? I believe that might have been about selling on the way up. And how is your point of view now on the buy side of the GPLP stakes changed from when you were trying to seek liquidity yourself? And then do you notice, it's actually a great question for you because you're geeks on a plane all over the world. Is it different regionally? Like where's the, what are you seeing in the world in this?
I think that's three different questions there. I'll try and work backwards from those. So maybe just on the last point. So, as Ira was noting, there's nowhere near enough secondary capital given how much inventory there is out there. That's even more true outside the US. And so, there's very few buyers for certain companies, even inside the US. I would say outside the US, that's even more so. We're somewhat active in Latin America. One of our partners is in Argentina, and that's probably about 10-15% of our capital is buying in that particular regional market. In those markets, we don't do as much fund secondary because direct secondary is not very competitive. And so we're typically buying direct secondary individual companies in those markets. We've done a few transactions in Europe and Africa and looked at stuff in India and Asia, primarily Southeast Asia. But it's still, I would say Europe is somewhat developed just because there are other private equity secondary buyers there, but the VC secondary market in Europe is still somewhat developing. And in most of the emerging markets, it's mostly non-existent. There are a few. Getting to the selling on the way up, this is a much longer conversation, but just as an example, we were holders of a company called Credit Karma from way back. I actually invested in the company when I was still at Founders Fund 15 years ago, which was probably one of my best investments ever. I think we got a 400x return on that. But strangely enough, when we bought that position out of 500 Fund 2, we actually bought a secondary from one of the founders after their Series A. And then we sold secondary 3 different times at valuations of, I believe it was $500 million, north of $1 billion, and then $3 billion. And for us, I have to sort of sit back and do the math here, but guess when we bought in around 60 million. So our first secondary transaction was done at maybe a 10x multiple, the next one at a 20x multiple, the third one at maybe a 40 or 50x multiple. And you might argue the 10x multiple is a little bit too soon or too early. But it was interesting for us. So again, this is really hard to unpack, and I'll maybe just describe how I think about secondaries today versus how I thought about that. When I was first thinking about it, was like, okay, as these companies get to 10, 20, 40x, I'm going to sell 10, 20, 30%, just to kind of dollar cost average on the way up. That's not necessarily a bad way to think about it, but a better way to think about it is what percentage of your fund's DPI are you generating from any individual transaction? And in particular, do you think the company is growing at faster than maybe your target IRR rate? And so one thing I would say is it's not really material to think about transactions that are going to generate, let's say, less than 0.1 or 0.2x of your fund size, unless you're doing that comprehensively for many different deals, and then in the aggregate, maybe it adds up. But I would advise people to think more about like when and how do you generate at least like a 0.5 to 1x DPI return from, a secondary sale or maybe a group of secondary sales if you're thinking about it that way. And what are you sacrificing in exchange for upside if you're doing that? And so in an ideal world, you could sell all of your company positions that are growing at less than 20%, because that's below your target IRR for your fund. And you would hold all the positions that are growing at, say, faster than 30%, because that's exceeding your current or your target IRR. In reality, the world is not so kind. You don't always have the opportunity to sell. The fair market value that you'd like to sell at isn't necessarily what the market will buy for you. And more importantly, is just you may not really be generating enough DPI to drive a material return. And so, again, when my former co-founders, partners at 500 sold positions in some of the bigger winners like Canva or Talkdesk, they were really looking to drive a 1 or 2x DPI return for their fund when they sold that position. But they were also looking at how much upside are they sacrificing by selling that position now versus generating more, DPI in the future. So that's just kind of the framework to think about there. There's a lot of other conditions to get to on all that stuff. Since we're maybe wrapping up, I just want to give people two things to think about. These are maybe pro tips. There's another secondary buyer that most people don't realize exists out in the market. It's called the IRS. And for people who are US taxpayers, you can donate your positions in illiquid assets to a charitable entity or your own donor advised fund in exchange for tax credits. And this is a more complicated process. You need to get a third-party fair market value assessment. However, there's many people in the market who are not going to pay you 80, 90 cents on the dollar for your asset. But if you can get a fair market value at 80, 90 cents on the asset, particularly in assets that may be optimistically valued from several years ago, you might find that you're better off just booking the tax credits for those transactions and donating them to your favorite charity, which might be your own donor advised fund. For anybody interested, happy to talk more about that subject, but there is a buyer of last resort, which is you.
Awesome. Thanks, guys. We're a few minutes over. I think that's because this is a very rich conversation. It seems like there are some offshoot separate webinars we could do on some of the things that came up, but want to be, definitely sensitive to our panelists' time. Dave, Ira, Phil, thank you so much for spending a full hour and change with Sidecar and our audience and kind of opening up the playbook as well as like hard-earned lessons over the years and kind of being generous with sharing and shedding light on what's an opaque market, but probably getting less opaque as the years go by. So hopefully our emerging managers have a better idea of how secondaries might fit into their own playbook as they proceed with their funds. So thanks again, everyone. There's a few questions we didn't get to. We have noted them, and we're going to try to follow up async and try to get those answers out. But thanks one more time, and we look forward to seeing everyone on the next webinar. Cool.
Thanks, Shri.
Thanks, Sidecar, for hosting.
Yeah.
I
Take
think
care.
you guys need to run a conference next time, not just a webinar.
We're thinking about it. We're thinking about it. Maybe we should talk.
Thanks again.
See you guys.
Bye, everyone.